there, traders. Todd here. Welcome to a little impromptu live stream. It is now Thursday night, the 20th. Big sell-off here, but after Netflix and Tesla earnings. But just want to touch base on some bigger picture themes that I'm seeing, and maybe answer some questions longer term. I think there's some pretty cool things happening right now in the market. There's always cool things happening, right? But specifically with inflation and the impact it has on some of the key macro themes that we're seeing, not just right now, but things that have happened in the past. And we did a pretty in-depth a report and then a follow-through. This is how we run our research process at Trading Analysis now. Is we start at the big picture macro theme and then progress through the week as we select good themes to trade, sectors to watch, sub-industry groups, watch good stocks, screen for fundamentals and technicals, and find the best stocks that go into our portfolios that we recommend to our clients at Trading Analysis, and the stocks that go in the portfolio at my wealth management business. So there were some cool things that I wanted to share with you guys and put them out there. And plus, as the headline says, I have some pretty crazy longer term Dow projections for you. You might think I'm absolutely out of my mind, but you know what? Who knows? I think you guys know I am anyway. So we'll take you through this chart. We'll get into a little bit of the Elliott Wave of the Dow, how it could double, and even more than that. We'll show you what's going on there. But first, I want to take you through that report that we shared with our clients and customers, and kind of show you what's happening here. So let me just bring this in. Let me make sure everyone's good. Looks like we should be streaming on 2 channels: Twitter, theoretically LinkedIn, Facebook, MySpace, Match.com, whatever. And that's the stock we're actually looking at trading. Okay. So this is the report that we put out, and we call it Big Macro Monday. Kind of fun. So I'll take you through some of the key parts, and we're just going to hit the highlights. So listen, again, this is going to be sort of heady stuff. All right, I'm going to be hitting you with some super long-term Elliott Wave. We're getting into some pretty crazy macro themes, but this is important. As a trader or investor, you always have to know, I think, start at a top-down approach. I was always trained as a trader when I was prop trading at 21. You always know where the bigger indexes are, higher time frames. You know what macro forces are driving those indexes, and then you move down and find the best stocks to trade. Even when I was short-term intraday trading, and that sort of school of thought is carried forward now 22 or 3 years later. As I'm running a research business and a wealth management business, I always start top down. So I know everyone likes to talk about good stock setups and when to buy and when to sell, but wouldn't it be cool if you could know and understand why things are moving and what impact rates and commodities and inflation expectations would have on the indexes, and then how that filters down into your growth and value sectors, and then why you're in Tesla or why you're in a value trade, and it gives you conviction to stay with your trade plan longer, make more money, cut the trade, contain risk when things aren't going well. It's important not to just trade like a single chart. It's just in front of you. You have to look at the market as a living, breathing thing. So that's what I'm attempting to do here, show you the bigger picture. So, the big thing that I see is, and I hear is, okay, yield curve inversion. And what that means is, the short-term rates are higher than long-term rates. And when that's the case, like this chart will show here, it is below zero. Zero line is right here. So we have 150, 160 basis points of inversion. And I've heard so many people, friends of mine on CNBC and everyone else, oh, holy cow, the yield curve is inverted. Oh my God, recession is imminent. We're coming, sell everything, blah, blah, blah. I'm like, okay, yeah, if you look at the last 2 periods of inversion, yeah, it has been pretty good sell signals in the stock market. Okay, the first one was back here in the tech bubble. Implosion, S&P sold off. Okay, next one was the housing crisis, GFC, yield curve inversion, sold off. But, what about the prior to inversions? What about 1982? What about 1989 and 90? They wound up being amazing buying opportunities in the stock market. Okay, so the last two were sell, the two prior were buys. Where are we now? And I think the key to understanding that is these macro relationships that I want to put in front of you. And again, that has to do with fixed income, as we're talking about, commodities and currencies. And that's what's cool right now is on the global macro rotation, all four asset classes are playing together. And that's when trading for me is really fun, because you have a lot of different major, huge markets all rotating together to help you get more clarity on where the market's going. Okay, and it's fine. Sometimes FX isn't playing, or commodities aren't playing, or interest rates aren't playing. And sometimes it's one or two. Right now, they're all firing. Okay, so if you look at this is the S&P 500 in red. These are quarterly bars. So going back to 1979, and I picked that because yours truly was born with the last year of a 7 handle, and I was on with my buddy JC Pretz this morning on his show, kind of talking about joking that. And then here is 30-year bonds. Now, what I see, and a lot of people don't understand this, is in 44 years, for the most part, stocks and bonds trade together. Stocks and bonds have a positive correlation. Bonds up, stocks up. Which means, remember, bonds up, interest rates down, stocks up. There's been two specific occasions where we saw clear negative correlation between S&P and bonds, and that was the 2000 sell-off and the 2008 sell-off. But then we went right back to positive correlation. Okay, and then in 18 and 19, when the Fed started raising rates, we had Chinese tariffs. Trump was threatening Powell with his life every day for tightening rates. Then we had a little bit of a negative correlation, and we went right back to positive. Well, here's where it gets interesting. Okay, we're back to negative correlation. And what's different this time? Can you see, and I've already put the labels on there for you so you can see what's up. But what happened those last two periods of negative correlation? During the tech bubble, we had stocks down, bonds up. GFC, stocks down, bonds up. What happened here? It's the opposite. Post-pandemic, stocks up, bonds down. So, okay, are you telling me that for the first time since I've been alive, we now are seeing a negative correlation between stocks and bonds? Are you ready to call the end of a 4+ decade trend? I'm smart enough to know that I'm not smart enough to be able to do that. And as a trader and investor, I hope you take that same tack. Tend to stick with the trend that's been in play for 40 years, okay? So that's kind of, again, sort of setting this up. All right, so what happened? Well, we had huge CPI, we had huge inflation during the 70s, stagflationary 70s. Inflation was going up, right? And gold was rallying as CPI was moving up. 1980 was a huge turning point, and that's kind of where the story starts. 1980, inflation stopped, CPI started to drop, gold dropped, and what happened? The Dow went on a historic run from 1982. I kind of consider that the IBM kickoff. We had 87 in there, but it was an amazing run in stocks. Okay, here's another look at the peak in inflation in CPI in 1980, and it coincided with the Fed no longer raising rates. Rates were up around 19%. And then once inflation was done, we then started dropping. CPI was dropping as Fed funds were dropping, right? So, okay, what happened right here? Well, here's CPI. We just printed 3, and St. Louis Fed here has given us a 2.9 handle in the year over year. So a lot of people were giving Powell a bunch of shit for saying it's not, he's saying it was transitory, and everyone's like, you're an idiot. It's not transitory. Well, if you look at this chart, I think it is. I mean, CPI is coming off as fast as it went up. What's missing is the Fed funds rate has not yet followed suit. Okay, and I've got reasons. I've got thoughts as we're coming into the next Fed meeting on the 26th next week as to what's going on here. And I can tell you, it's not in the presentation. Maybe I can pull it up later if you guys want. But you look at the 2-year yield and 2-year inflation expectations. They're locked at the hip, but there's a huge divergence right now. Okay, because 2-year yields, which follow Fed fund rates, have not yet really rolled over, but inflation expectations 2 years out right now, I'm telling you, is about 1.5%, well below the Fed's expectation. So my point there is at some point the Fed is going to have to stop clubbing us over the head with higher for longer, tougher talk in the press conference. Powell can't say I'm done raising rates because stocks would rip, but he's got to start backing away a little bit, and I think the markets are starting to price that in. And that's one of the key themes. I'm not going to get too much further into this, but the big theme that I want you to start picking up on is if inflation has peaked, what happened in the 70s transitioning to the 80s following that big inflationary spike? What happened to commodities, fixed income, and stocks? Okay, so this is the 1980 peak. What happened? Yields on the 10-year bond sold off sharply. Behind that, in teal, is the S&P 500. Okay, S&P 500. And then in green is your CRB. This is the Commodities Index. It's been turned over by owners multiple times. So what happened in 1980? Inflation peaked, Fed funds peaked, yields dropped, and what happened to commodities? Commodities were on a freaking tear in the 70s because of inflation. Then, as we started to move into something called disinflation, which is inflation but at a slower rate of change, yields came off, commodities came off, stocks broke out of the sideways 70s and went on a huge tear into 2000, which is right here. I know the scale's really, really small. Okay, so what is happening right now? Okay, well, and we'll get into current day and kind of pull it forward, but 10-year yields, we know they're trying to break above 4% or failing, and commodities have moved up a little bit. But remember, are we moving into a disinflationary period, something like the 80s, which saw commodities drop? And I'm kind of teasing it here. It has something to do with BRICS. Okay, and I'll explain what that means here in a little bit. Okay, this is just another chart showing gold. Okay, so gold in the this was I'm gonna skip this one. We'll come back to gold. Gold traditionally does well, right, in inflationary periods. This was the 2002-2003 top in gold, as CPI was coming off, right? So gold down, CPI down. And then we started to get a resurgence in inflation and CPI. Gold went up, and now we have CPI dropping. Gold hasn't dropped yet. I am bearish on gold. I don't think it's going to rally, where the Dow has rallied. So a good macro indicator a lot of people use is the Dow-gold ratio. So Dow was outperforming gold from 1980 up to 2000. 2000 down to 2011, the Dow-gold ratio was dropping, which means gold was outperforming gold was outperforming the Dow. Now, I even put a little Elliott Wave count on there, looking to break up through here, and that would mean Dow, again, is set to outperform gold. And when did the Dow outperform gold? That was the peak in inflation in 80s all the way up to 2000. So watch that Dow-gold ratio to kind of confirm what I'm saying. Okay, so we're seeing a pretty good correlation between yields, U.S. yields, and commodities. And I think commodities, which not a lot of people are talking about, may be the key to what we're seeing going forward and give us clarity from a macro point of view, like an intermarket perspective point of view, as to what stocks you're doing. So yields up, commodities up. Okay, CPI is falling sharply. And we know generally that pushes yields down. And we know, because of the correlation with commodities, that if yields go down, commodities might go down. All right? So let's bring in the dollar. So commodities, CRB in black, and the US dollar in green. clearly an inverse relationship. This is 1996. That's the 2000 top. There's the 2008 GFC. I was trading on Wall Street for a FX hedge fund and writing research report for a brokerage firm during this period. Really fun. That was the big move into the US dollar for safety, big old inverse correlation between commodities and the dollar. Well, 2016, 17, and 18, look what's happening. All of a sudden, they're trading together. That's interesting. That shouldn't really happen. They usually have a pretty good inverse relationship. So all of a sudden, we have commodities trading with the dollar. So what's happened to the dollar? The dollar's broken down sharply. Okay, the US dollar is down. Again, we have a good correlation with yields. Where yields go, 10-year yields, generally, you got to look on the other side of the FX trade where yields in other countries to create that interest rate differentials to figure out from an FX point of view. But there's generally a pretty good relationship between US yields and the dollar. Yields, again, can't really break through 4%. And today we saw a pretty good move into value. Growth stocks got clocked after Netflix and Tesla, but look at the 10-year yield. It was up 3.85%. And that was also pushing the dollar up. But at bigger degrees of trend, the dollar has broken key support. That should weigh on yields. Yields down. Okay. So kind of the main point that I'm making here is, in the 70s, and the CRB commodity was rallying, commodity index was rallying because inflation was out of control. Started to rein inflation in through the 80s into 2000, commodities dropped, and that's the CRB, and that's what allowed the stock market to go from the 1982 to 2000 amazing rally. What happened to commodities in late 90s into 2000? In comes Jim O'Neill. He was like managing director, head of research at Goldman. He coined the phrase BRICS, and that was Brazil, Russia, India, China. Emerging markets coming on, demanding a lot of commodities to build out their infrastructure, and they're also producing commodities as well. So the more that these emerging markets came online, the more they produced and consumed commodities, which created a positive correlation between stocks and commodities. And you can see the 20-period rolling correlation here of commodities and the S&P. And again, I know that the dates are really small here. Right here is 2000, 2001, up to 2007. Here's the GFC. We had a very strong correlation between stocks and commodities. All of a sudden, we dropped away very, very sharply. Commodities sold off in 15, 16, 17, and 18 as the stock market continued to go. So this was the BRICS era that had a positive correlation of stocks and commodities. Well, recently, we've come back on the positive correlation. Okay, so we have stocks now trading with commodities. Why would that be? I don't know if I fully agree with that. Did you see China's most recent GDP report? Q2 is only up 0.8%, and their unemployment is problematic. Brazil's got problems, and we know where Russia's at. India is certainly coming online and doing great, but there are problems, and I'll show you the BRICS chart. So the correlation between stocks and commodities was positive at the turn of the century, lasted until 2013 and 14, but now these markets are online, and who knows really what the future with China holds. I don't think they're huge out there demanding a lot of commodities to continue to build out their infrastructure and cities as they have, unoccupied ghost cities and et cetera, et cetera. So what does all that mean? Well, BRICS countries have been underperforming for a long time. This is the Dow Jones BRIC 50 index going back from August 2010. Okay, and I showed you right about 2010, 11, 12, into 13 and 14 is when the relationship broke apart. So the BRICS index has been sideways from 2010 to here we are 2023 on a monthly relative rotation. So we have the BRICS 50 benchmarked against the S&P on the this is a quarterly chart. Tried to rotate into the leading quadrant, got denied, and is big time heading to the left. These guys have been underperforming. Emerging markets, specifically BRICS, have been underperforming for a long period of time. I think that commodity relationship is over, right? So there's a chart that I want to show you here. Again, just kind of underlining what's happening is that positive correlation between the CRB and the S&P fell off, and now we're back to a positive correlation. It's very overbought right now. Okay, it's very, very overbought. So I'm wondering if we start to see commodities drop like we saw in the 80s. And if we go back to this chart right here, I'm wondering, are commodities at a point where disinflation, which is CPI falling faster and faster, it's falling as fast as it rallied, might start to produce, sorry, I just flipped my mouse wheel there. I'm wondering if the CRB might start to drop once the Fed starts to ease off on the very hawkish talk, being that BRICS are no longer creating a positive correlation with commodities. I wonder if commodities may start to decline, gold included. Okay, we know crude oil can barely get a bit above 75. And I'm wondering, because the big problem that we had with this recession, the stock market sell-off, was not so much earnings, but it was margins. It was a margin recession, and if we have disinflationary forces, I'm wondering if the commodity aspect, the inputs, as we are going in and building out batteries and storage facilities for energy, and we do need minerals out of the ground. Commodities are going to continue to be demanded, but at the whole, technology is disinflationary or deflationary, as these GPUs out of NVIDIA are making companies much more efficient and productive. They're a big, heavy cost up front, but they're incredibly powerful, and they're lowering their cost of doing business, increasing margins. So, I'm wondering if commodities might start to decline, and we may go back to a 1980s style disinflationary commodity sell-off, which should drive interest rates lower, and then wondering if we do go into a significant bull market based on that. Okay. All right, so let's get into where we are from the Elliott Wave point of view, and let me just see how we doing over here. Looks like we're still rolling. Okay. Okay, so that's that. Let's take a look at, that's a stock we're in right now. Let's take a look at the Dow longer term, and I'll give you an Elliott Wave point of view. This is pretty fun. Okay. So, you guys know I love Elliott, and it's one of the most controversial, misunderstood, hot button areas of technical analysis for decades and decades, right? It's based on Charles Dow theory that the market advances in three phases. So 3 trend waves. The first one is accumulation. The next one is the middle and usually the strongest wave. That's called widespread participation. And then the final trend wave is called distribution, right? R.N. Elliott, Ralph Nelson Elliott, back in the 1930s and 40s, took that work from Charles Dow and expanded on it greatly and gave us 13 set of rules and a series of guidelines that we would look out for. Now, yeah.
Is a statement by which to determine a course of action. A guide.
Siri literally just interrupted me in my presentation. That's weird. So where are we on the Dow? Okay, and I'm going to assume you have some working knowledge of Elliott Wave. I'm not going to make this an Elliott Wave session, but here's the wave count as I see it going back to pre-29 crash. Now, this is a wave count that I think is unbiased, is right, is not self-serving in any way, and I think it obeys the most amount of guidelines and rules that Ralph Nelson Elliott gave us, and then he passed the wave theory on to multiple people, right? There's been multiple sort of people have run with the torch that's been carried forward to today, and there's been a lot of rules kind of made up, since the 1980s and 90s, based on the work that was provided to us originally back in the 1930s, 40s, and 50s. So the way I see the wave count here is, we really started recording prices back in the late 1880s here in the U.S. And of course, there was a stock market prior to the U.S.'s economy coming online. We can talk about that another time, but we had a pretty good rally from the early late 1800s Industrial Revolution through the Roaring 20s. My data starts at 1928, and then there's a 29 crash. Okay, so the 29 crash was there. We rallied up there to 1936, and we did a big old ABC there. This was into the start of World War II. Now, this was an ABC correction. It was a 52% decline. So what we have here is a 1-2, 1-2. Now what we're doing here is now we're inside of this wave 3, which this degree is the cycle degree wave 3. A wave 3 needs to break down into 5 smaller waves. So looking at wave 3, again, we're going to look for cycle. Inside of cycle will be 5 primary waves. The primary waves, the way I see it, is here, 40s, 50s, into the 60s was wave 1. Now I can break that down and show you inside of that. It was a nice 5-wave move. And inside of wave 3, you can even see 5 smaller waves. So the 5-wave move inside of 3 holds here. The 5-wave move inside of trend wave 1 holds here. Fine. I have the stagflationary 60s and 70s when we had that major inflation problem and a drive up in commodities as wave 2. And I think that if we know with the benefit of hindsight that we're going to go into a massive disinflationary 1980 to 90 early tech boom into later tech into a wave 3, that makes sense. And there's a lot of people who would say, that we are over and we have a significant wave 5 decline to come. You have to embrace the fractal nature of Elliott. Rather than try to count every 5-wave move and say, this is the end of it, get out of your trend trades and short, it doesn't really work that way. Okay, just a quick aside, Elliott Wave, very quickly, it's a scorecard for how we're doing collectively as an economy. And now that we are global, how we're doing collectively on the global economy. The better we're getting along, the more ingenuity, the more productivity, the better we're doing, the better our output is, the larger our economies grow, the more people come online who are producing and consuming goods, the greater the valuation of our markets and the higher those stock prices go. Elliott Wave is really studying mass human interaction and our progress forward. At the biggest degree of trend, I think we are progressing forward. I think civilization is getting better. Okay, I am by nature an optimist, but I'm also giving the rules and looking at the rules that were given to us and say, based on certain characteristics that we've seen in waves 1, 3, and 5, and the corrections, what wave are we likely in? Well, I very strongly believe that the 60s and 70s were a wave 2 because it preceded a very strong 1982 to 2000 run. Now, we had a very shallow ABC correction here in the 70s. When you have a very sideways wave 2 correction, that usually means there's a lot of freaking strength in this market and it's ready to roll. And that's exactly what happened from the 70s up to 2000. Okay, then we had tech bubble, housing rally, housing crash. Beautiful ABC expanded flat in wave 4. Okay, now before we go any further, I want to introduce you to something called an Elliott channel. All right, an Elliott Wave channel is simply this. If you want to know how to properly draw oh shoot, sorry. I wasn't showing. That's so bad. Sorry. Boom. Sorry, guys. Okay, back to where we were. So wave 1. Up to 1965, down into 75, the big wave 3 move up, and then an ABC pullback there in the tech sell-off, housing bubble, housing crash. Okay, so what I was showing you is, okay, where is the Elliott channel? How do you draw an Elliott channel? What you do is you take the highs of 1 and the highs of wave 3, you draw a trend line, and then you make a parallel. And then what you do is you project it off the low at 2. So you do 1 to 3, connect it, project it off at 2, and it often gives you the low in 4. That's exactly what happened. Perfectly. Okay? So, all right. So now we have wave 4. Okay? So what is happening here? Well, let's look back. You need to have something called proportionality. You need to have waves that have something called the right look. The percent distance traveled and the time elapsed in the same degree waves have to be somewhat similar, and often they're related by your fib numbers. So wave 1 lasted 980%. Okay, we went from 1942 low, World War II, up to 1965. The Beatles had been here for like 6 months or a little over a year. 980% rally. Then we did ABC sell-off in 2, which was actually a 23% decline, net decline. Then we went on wave 3 rally. This was 1960%. Okay, so usually wave 3 is the longest wave. Remember in the beginning I said there's 3 main market phases that Charles Dow gave us, accumulation, widespread participation, and then distribution. Well, this is widespread participation. 1960%, what is that compared to 1980%? Basically 200%, right? So the distance traveled in wave 3 was twice the distance traveled in wave 1. Okay, there's another tendency in Elliott Wave, which if that's the case, wave 3 is a long extended wave. Many times the distance traveled in 1 will be equal to that in wave 5. Okay, so now we're starting to work some upside targets in wave 5. So let's look at a 5v1 projection. What does that mean? Well, the percent distance traveled in 1, I already mentioned, was 980%. If you project it off of the low from the 2009 low, 61% of that was Dow 28,156. We thought about holding it here, right here, sold off into pandemic, and then rallied right back. 100% is more typical, and that is going to be up here at 68,000. Okay, what that means, again, simply percent distance traveled, 980%. Project the same amount off the global financial crisis lows is 980% right there for wave 5. That's proportionality. Okay, now there's some other fibs, which is a typical fib. What you do is you take percent distance traveled in 1 and then project up from 2 based on your fib multiples. That's just another way to back up your wave 5 projections. So we had a really tight zone in the Dow here at about 27,000. These 2 blue levels right here. And we held. That was 18, 19, into 20, and we finally broke above. There's another one just above us here at Dow 68 to 69,000. Okay. Now, let's get off the 3-month chart, and let's go down, and let's look inside of wave 5. So go from the quarterly chart down to the 1-month chart. So here's your tech, housing, rally, housing, crash. Now, a lot of people don't understand this, but the 18 up to 19, 20 pandemic, this ABC correction right here was the largest percent distance correction that we've seen since the global financial crisis lows. That means this has to be a larger correction in terms of degree than anything we've seen yet. This is a wave 2. All right. This decline was 32% net, the beginning of wave 2 to the end of wave 2. This little guy, much less. Okay, a little wave 3 here. This guy was 15, and this guy was, net distance was nothing, 7%. And if you want to go from the B wave high, 19%. But you're looking at the net percent distance traveled in your correction. So wave 2 started here, ended here. Wave 4 started here, ended here. This ABC is a wave 2. Now, what's interesting is we're doing another 1-2. Okay, so I do think we are setting higher in wave 3 of 3. Okay, now let's get off of this smaller green degree. Let's focus on the blue ones. Where are we near term? All right, well, we know that a wave 3 usually goes at least as long as the distance traveled in 1. How far has the Dow come from the GFC lows to where we are at the top of wave 1? 315%. All right, now if we do 315% from here, that's going to be right there, 100% at Dow 76,000. Here's the crazy thing. Traditionally, we do a 1.618 relationship of 3v1. That's up here. It's a lot higher. Now, here's another important point. A lot of people use Elliott Wave to say the world's coming to an end, huge crash, get your gold, pitchfork, shotgun, shovels, bottled water. Let's use the rules of Elliott and guidelines and look at what's happening here. Once we get the 5-wave move from here, it'll complete 5 of a higher degree 5. Let's go back up to that quarterly and let's get the context of where we are in the wave count. Come on. Okay. So we're talking 1, 2, 3, 4, orange 5 to complete green 3. That green 3 is going to square up and set up a wave 4 correction that pairs up with the same degree as the correction back here. The first setback post 29 crash from 1936 to 42. This was a 52% decline. And this was also fairly directional, a zigzag correction. The guideline of alternation Elliott Wave says if you have something fairly directional in wave 2, you're probably going to get something sideways and choppy in wave 4. So I think once we get through this, and we're talking years, decades down the line, we will have to square up and do a wave 4 correction that, again, will square up with this wave 2 way back here. At that point, then we go up into wave 5. That will complete a larger degree wave 3. And at that point, then we have to contend with the 1929 crash. Again, 1, 2. 29 crash was a very sharp wave 2. Probably this guy, we're talking decades down the line. Probably a sideways, real choppy sideways back and forth period before we eventually move higher in wave 5. You know, this is out way out in the future. So the point is, guys, we have 2 wave 2s that were fairly directional that we need to correct. And usually they're just going to be sloppy and choppy. I'm just trying to, come on. Okay. We have this wave 2 that we're going to have to correct up here, probably sideways. We're going to have this higher degree wave 2 that we're going to have to correct sideways. There's nothing that I see that is going to foretell a significant, scary end of the world decline, especially if we're going into a period where we do have a control on inflation. Disinflation is upon us. The Fed's going to have to get easy. And we have the 1980s to rely on as a model as inflation's falling. Commodities may be dropping now that we're not seeing BRICS demand anymore. China, we know, is kind of flat. They're working off a huge growth period, you know, in heading into 2007 and 8 and before that. So, you know, I think we're heading into a disinflationary period, falling rates, falling commodities. We'll see what the FX market does, but that is a good market for stocks. Disinflationary periods, especially if we don't have a positive correlation with commodities. If commodities are going to drop, that's going to take care a lot of the margin issue. Input costs, employment's another factor. but this is certainly going to help those margins. And that was the recession that we just saw, was not a recession in earnings, but in margins. And that could be the answer. Okay. Hope that helps, guys. And thanks for sticking around. And see you guys at tradinganalysis.com on the research side. And then we're going to be launching Inside Edge Capital, wealth management business that's already up and running. We're going to get ready to onboard our next group of clients here shortly. Okay. Thanks, guys. Appreciate it.